What's driving markets? Welcome to Market Take. Each week we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Devan Nathwani, portfolio strategist at the BlackRock Investment Institute. This week I'll delve into why total fixed income has returned to the credit market and why we stay selective. Today's high for longer rate environment makes income earning assets more attractive than at any time in the past decade. The total income on offer across the credit space provides long-term investors relatively safe yield. We prefer pockets of credit where the total yield better compensates investors for credit risk. Today is a much different environment for fixed income investing compared with the pre-pandemic. In the wake of the historic global interest rate hiking cycle, long-term investors no longer need to take on extra risk to earn income. Higher yields mean the income is back in fixed income. US investment-grade companies have less than 10% of outstanding debt coming due annually through 2030, according to Bloomberg data. We don't see a maturity wall. Many companies took advantage of low rates early in the pandemic and converted short-term to long-term debt. As a result, US corporate net interest payments plunged even while the Federal Reserve was hiking rates. While the total income on offer is attractive for fixed income investors, we stay selective in credit. Spreads have tightened largely as a function of limited new supply and resilient corporate balance sheets. We get granular, preferring high yield over investment-grade credit where the total income on offer is higher. Regionally, we prefer European over US credit where spreads aren't as tight. Uncertainty is heightened ahead of the second round of the snap election in France on July 7th. The country makes up almost 20% of the European corporate bond universe, so the election remains a source of risk for investors. We like private credit over public credit on a strategic horizon of 5 years and longer. Default rates and covenant amendments have risen but are below distress levels in our view. Private credit should also play a key role in the transformation of the global financial architecture. We see rising appetite for non-bank lending, driving steady demand for private credit. Yet private markets are complex with high risk and volatility and aren't suitable for all investors. Here's our market take. The income is back in fixed income. We like pockets of credit where investors are more compensated for risk, yet in a whole portfolio context, we prefer taking risk in equities. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com